Well, it's all about the energy markets. During the summer period, natural gas prices in Europe have surged. In the UK, about 175% in just 1 month. A little bit longer period, over 200% in Europe. That is going to have significant negative implications for real incomes and therefore domestic demand across Europe and in the UK. We're beginning to see the economic data indicate a turn in business sentiment as well. The PMIs this week dropped below the 50 level, indicating the potential for economic contraction. Bizarrely, financial conditions have eased during the summer months. That is not what central banks want. We think the equity markets are about to turn. We've seen some softening of the bullish sentiment. Equity markets have corrected a little bit lower. We think there's more of that to come. Financial conditions need to tighten to get to grips with out of control inflation. In those circumstances, you stick with the US dollar. There's further dollar strength ahead. Well, I think they must. I've just mentioned financial conditions have eased through the summer, and central banks won't be happy with that. They need tighter financial conditions to bring down inflation expectations. So I think the Fed at Jackson Hole on Friday will keep its tough rhetoric, keeping expectations elevated in terms of monetary tightening through the end of the year. I think it's the same in Europe. Even though we have the negative implications of the scale of increase in natural gas prices, inflation is ahead of what both the Bank of England and the ECB were expecting. And in these markets where inflation expectations could suddenly rebound again, they're going to have to continue to tighten. So tightening at each meeting through the rest of this year as well in Europe seems more likely now than not. Well, euro-dollar has just broken parity again. It broke parity last month, but rebounded very quickly. It's now down on a more sustained basis below parity, and I think that certainly opens up scope to the downside. In circumstances of broad US dollar strength, tightening financial conditions, recession coming in Europe, 95 is certainly, I think, very achievable over the coming weeks and months. For the pound, the risks actually could be further to the downside. And there's a couple of unique factors that could undermine confidence in the pound. Number one, the off-gem cap adjustment means the impact from what's happening in wholesale prices won't come until the first quarter of next year. And inflation predicted by the Bank of England at 13% looks old news already. Projections of 15, 16, 17% now in place because of wholesale gas prices. Secondly, we have political uncertainty. Will Liz Truss, if she wins, be supportive of UK households? She was reluctant in the leadership campaign to promise much. Will that change? If it doesn't, that could potentially be another negative. Thirdly, the UK is running close to a record current account deficit. That leaves the pound vulnerable if we do get those tightening financial conditions. So there are these factors that I think could weigh on sterling. And finally, leveraged funds have been buying the pound, anticipating a rally and a strengthening. If that doesn't emerge, we could see those positions liquidated, and that could reinforce pressure to the downside.